out there. My name is Kapil Mehta. Again, welcoming you to a series of webinars conducted by PIHM City in association with Parul University's webinar organizing agency. Once again, a very good afternoon to all of you, and a good afternoon to our guest speaker, Mr. Kapil Joshi. He's a practicing chartered accountant, and he is a company secretary also. So it's our privilege, and we are honored to have you welcomed on the platform of PU webinar, Mr. Kapil Joshi. Thanks
Yeah,
for coming. Thanks for joining.
yeah. Thank you. Hello, good afternoon, everyone. And I would like to thank Mr. Kapil Mehta and Parul University for giving me this wonderful opportunity to share my knowledge with all of you. Today, I'll be briefing you about the importance of financial management in hospitality industry, that how the financial management play a role in success of a hospitality industry or any business in hospitality industry. So, should we start?
Yes, yes.
Okay. So, before moving further, whenever we heard this word financial management, what is the first thing which come in our mind is money. So, money is as important as blood in a body. Money is as important as business as blood in a body, because without proper and sufficient funds you cannot run a business, or you can't even think of that running the business. So in simple word, the financial management is nothing but just the how well you manage the money, how well you manage funds. So if planning, organizing, directing, and controlling the financial activities as well as the financial resources of the enterprise. So, so let's start with an example. Uh, for suppose if you want to establish an hotel or restaurant or resort. So so before thinking of the idea, you must evaluate that how the how you will how will the estimate the exact capital required for that starting the business. So so it is the time where the role of the financial management is very crucial and comes into the role. So so if we move to the next slide of presentation, we can find that uh, what are the basic function of financial management. It states that the what are the basic duties of a financial manager in an organization or any business. The what a financial manager do. So the first and whenever we think of starting a business, the first and foremost thing which is required is it's an idea the what the business is, what kind of services we are going to be provided, and what will be the what will be the what will be the required capital to run the businesses. So the first function of the financial management is estimate required capital. Required capital means the how much fund which should be required to run the business. For example, you will be requiring a land or building or a certain human resource, inventory, and other plant and machinery. So so you will evaluate the exact cost of that project. So so after after determining the exact the required capital, you need to determine that how much I have in my pocket and how much I need to borrow from the external sources. Because because for a new entrepreneur, in the most of the cases it is not possible that he got all the money, because because whenever we think of an idea, it requires a huge capital. Or as we can see, hospitality industry is mostly based on mostly all about service industry, and in service industry the competition is a very cutthroat competition. So the level of the level of the level of infrastructure and the quality of service play a vital role in success of any business in hospitality industry. So after determining the estimate required capital, we need to understand that which sorts of funds are available in the market. For suppose there are we can borrow money from our relatives or our family member or banks. So whenever we start a new business, generally bank will not rely on us because we are new. So whenever we start a new business, we have to arrange from our relatives, our known ones, and we just need to evaluate the how the how the resources will be available. And after we procure all the funds which we required, we the next decision we have to take is allocate and control the funds. That where we should allocate the funds, in which how much we allocate in fixed asset, how much we allocate in for example current asset like in inventory, and in inventory for suppose in different investment like you can say some investments and etc. So we will now take a brief understanding of the function of the financial management, as we have discussed the above 3 points, and so we will move to the fifth point, that is management of cash. So finance manager has to make decision with regard to cash management. Cash is required for many purposes like payment of wages, salary, payment of electricity, water bill, payment of creditors, meeting current liability, maintenance of enough stock, purchase of raw material, etc. And we have to also take the control of the financials. The financial manager has not only to plan or procure or utilize the funds, but he also has to exercise control over the finances. This can be done through many techniques like ratio analysis, financial forecast, cost and profit control. So why financial management is very crucial, and why financial management is required in any sort of business? What is the why the financial management is very important in any sort of business? We will understand by this some sort of point. The financial management is generally concerned with the procurement, allocation and control of financial resources of a concern. The objective can be to ensure regular and adequate supply of the fund. The business activity should be adequately funded so that the business operation can be successfully run. And the second one is to ensure adequate return to the shareholder, which will depend upon the earning capacity and expectation of the owners or shareholder. And the third point is to ensure optimum fund utilization. Once the funds are procured, they should be utilized in a maximum possible way at least cost. And to ensure safety on investment, that funds should be invested in safe areas of activity so that adequate return can be achieved. It means safe area means the most profitable most profitable activity. We should not invest in activity which do not generate much profit. And to sound and financial management also help us to plan a sound capital structure. There should be sound and fair composition of the capital so that balance is maintained between debt and owner's capital, because the proportion of the debt and owner's capital will decide the how the financial structure, how good the quality of the financial structure is. So let's move to the further slide. Whenever we talk about hospitality industry, the as it is a service industry, as we have already discussed, the quality of service and the quality of the infrastructure play a vital role in success of the hospitality industry. So we will discuss some challenges with reference to the financial management a hospitality industry generally face. So what are the challenges? The first challenge is capital requirement estimation of a project. Whenever we think of a new idea or a new venture, the first problem we face that how much capital is required to run this business. Because if we fail to estimate the required capital to start a project, the project will ultimately collapse or close down. And for example, if we properly estimate the required capital, the second thing we face is the what should be the capital structure. for suppose you want to open a restaurant, and you think that rupees 10 lakh rupees is required to open that restaurant, and you have for suppose you have 6 lakhs in your pocket, and you require 4 lakh rupees more from external sources, but you are aware of that the restaurant will not generate enough profit to pay interest that a bank will charge, or the other expenses like the employee salary cost, other inventory cost. And if you think that you will not be able to pay the interest cost, etc., then you should make the available from your relative or your family member, so that you do not need to pay the interest, or you can run your business successfully. So, and the third thing which comes in our mind, and what are the available sources of funds which are available in the market. As we know, the first fund is owner's fund. We can procure it from family member, relative, friends. It is easily actually available, because it depends on because these are the internal source of finance. You can make it available easily if your idea is good enough. But when we go for some external source of from finance, the external source of finance are loans from bank, NBFC, financial institutions. Then the strong business idea is required, and strong credit rating is required, because before giving loan, before sanctioning loan, bank will evaluate your project, that how profitable your project is it is it possible you to pay the required interest or to required installment that bank will charge. So you have to in that case you have to convince the bank that in that case you have to convince the bank that our venture is very profitable, and we will be able to pay the interest and other debt repayment. And the fourth thing is which type of source of fund is suitable for organization. It will depend upon the scale of your organization. If you are thinking of the an opening and resort, and you know that you will require a capital of around 15 crore, and you belong to a middle class family or upper middle class family, and suppose you have 5 crore with you, and you have also have land to construct an resort and hotel. But after that after that also you will require such a such a huge such a huge amount of money, like 9 crore, 8 crore. So you have to go for the external fund, that is borrowed fund. And it will also depend on the profitability of the project. And if you know you are going to open a resort or hotel, and which will generate profit around 20 to 25% of your on 20 or 25% on your total investment, then you are ready to go for the external finances like borrowed fund, because you will be able to pay 9 to 10% interest, and that will be very okay for you, that will not cost you much. And uh, one more one more one more and very most important challenge the the hospitality industry or any sort of business face, the capital is the capital is available at very high cost. Because if we look at the business loan rate, and especially when you are new in the business, the bank will charge you higher rate. And if you are unable to generate a good amount of revenue, then you will not be able to repay the interest or debt amount, and that will ultimately lead you to the close down of your venture. And the other challenges which a business, which a hotel or resort or restaurant faces in terms of financial management are poor budgeting and cash flow management. Um, so we will discuss further the budgeting and cash flow management in 10 to 20 minutes. So what how the poor budgeting and cash flow management affect the success of an organization. Budgeting is nothing but a planning in advance the upcoming expenses and upcoming revenue, that how that you will uh, what what are the standard what are the standard cost of any expenses like salary, inventory. You just plan in advance that how much it will cost me to how much inventory will cost in next 6 months, how much salary we I have to pay in next 6 months. And cash flow management is all about that how well you manage the cash, that it not lead to the cash shortage. Because cash shortage may also affect a certain operation of your business, certain continuing operation of the business, and that will lead to incur losses in the business. And and the next one is poor allocation and utilization of fund. allocation of funds involve Allocation of fund involve whatever money you have in a business, you need to allocate that in a proper and a right proportion at the right time. Because because uh, for example, if you are thinking of opening a restaurant, you have two type of asset in that restaurant. You have building, you have furniture, and you have a certain machinery, like machineries, uh, normal, uh, like air conditioner and other machinery. So you need to plan in advance that how much fund we I need to allocate on fixed asset, and how much fund I need to allocate on or short term or short-term assets. Short-term asset include inventory and human resource, because and short-term investment, you can say electricity, telephone bill, and other utility services. So you need to plan. If you, for suppose, if you allocate the entire fund on fixed asset, you will fall short of cash for that short term assets. So ultimately the poor allocation and utilization of fund will affect the operation of the continuing operation of the business. If the continuing operation of the business is not going well, then in any case it will lead to losses and closure of the operation. And the second last is inefficient monitoring of financial management process. Inefficient monitoring of financial management process. So there should be established financial management process. Financial management process involve procurement of funds, allocation of fund, oversee the how the funds are being used, and whenever you required fund, there should be readily available fund, because whenever a business activity require a fund, it need to be compensated immediately. Otherwise that activity will not be able to perform, or that activity will not be able to generate revenue for you. And the last one is poor financial management information system. As we all know, the management information system include the information like sales figure, cost figure,
Yes.
and sales figure, cost figure, what are the interest rate, and there should be a proper management information which assist or help the financial manager or you to plan a proper financial management policy in the organization. As we have discussed the some of the challenges the financial management in hospitality industry face. So so now we will understand some of the key concepts of financial management. So the first one is budgeting. So what is budgeting? Budgeting is the one of the most important concept of financial management, and it involves spending money. So sorry, spending without a plan or without regard to sales can lead to overspending. It will result in missed bill payment, decreased profit, create a master. So you need to create a master budget each year for a business that include income and expense projection, a cash flow statement, a balance sheet, and profit and loss statement, and perform a budget variance analysis each month or quarter to determine if your budget projection were accurate, if they need to be adjusted. So you can see the how the budgeting is very important for a business. And the second one is reporting. Reporting is nothing but the reporting the daily transaction, or that how you report all the financial transaction in the organization. So to make the most effective decision regarding marketing, being a distribution strategy, pricing, and other aspect of your business, you need accurate information regarding how each decision you make might affect your bottom line. Bottom line means profit. Accurate and regular financial reporting help you to know exactly where you should stand financially, and how different areas of your company and different initiatives are performing, and what your resources are. A balance sheet let you see the company asset and liability at any time, and cash flow report tell you if you can pay your bills or on time, or collection process is if your collection process is insufficient, and knowing your available credit and what your interest costs are provide important information about your purchasing power and profit margin. And third one is cash flow management. The common reason a small business struggle or fail is poor cash flow management. Even when income is greater than expenses, you will might find yourself short of cash and unable to pay your bill if you don't time the receipt of your sell invoice with a due sales of your bills. And accurate and timely cash flow statement help you to avoid production shutdown and loss of customer and damage to your credit. For suppose for suppose you are making your sales figure are good enough, and but you are not able to recover the money from your debtors or your receivable, and on 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 a specific time basis, then you will ultimately run out of cash, and that will lead to your damage of your damage in your credit reputation, and you will ultimately unable to pay to your creditors, your suppliers, and that will ultimately lead to ultimately lead to ultimately lead to poor financial management. And the last one is debt service. Debt service is nothing but debt service means whatever the funds which you procure from the external sources, or it may be from internal sources, unsecured loan, the how much it costs, that how much interest you require to pay on monthly basis, on yearly basis. So you need to plan, and if you fails to pay the interest or installment on timely basis, and that will affect your credit score. And if it affect your credit score very badly, you will not be able to get funds in future. So the more debt you carry, the more interest you pay, raising your overhead costs and lowering your profit. Even if you have no problem paying your credit cards bills or loan amount, high debt can lower your credit, potentially decrease your ability to get more credit when you need it. Raise the interest rate you will have to pay on future borrowing. Effective financial planning include monitoring your debt, managing it on a regular basis. as as in upcoming year you will be graduated from the university, and you will have two option in your hand. The first one, you will join an organization as an employee, and the second thing is you will think of starting a business. The role of financial management will be very less when you join an organization and work as an employee, because there will be a separate financial department in that business. So you will have to work on your skill and other skill only. But when you think of an idea of starting your own venture or your own restaurant or your own resort, the financial management play a very very big role, because even after generating the huge operating profit, you may suffer loss due to poor financial management. Let's take an example. For suppose you will for suppose you have made sales of rupees 100 lakhs, that is 1 crore, and your operating expenses are nearly 75 lakhs, and so you have generated the profit from the operation around 25 lakh. But you have generated the profit of 25 lakhs. It means your operation are good enough to generate a good amount of profit. But the funds which you procure or which you used in the business, you borrowed from the external sources which are very costly. For suppose they are charging interest. They are charging interest at the rate of 18% or 20%, or so we'll so if you are if your borrow fund are for suppose 70 lakh, and your interest rate is 20%, so you are so 20% of your amount, uh, uh, 14 lakh out of 25 lakh will drain into the interest costs only, and you will not have enough cash available with you to grow your business venture. So so understand the implication of poor financial management in any business. Yes. So now, once again, yes. So when you think of starting your own resort, your own hotel, own restaurant, first make sure that your idea is good enough to generate a ample amount of revenue that will cover your operating cost. Operating cost means being at inventory, being at employee cost, and general expenses like electricity, telephone bills, and other expenses such as traveling and all, etc., etc. And after meeting that expenses, there should be a proper there should be an ample amount remain left for the financial expenses. Also, financial expenses include interest cost and other processing fee and etc., etc. One second. Yes. So, how you will implement the concepts of financial management in your organization? Think of this. So, first you need to evaluate the capital requirement, that how much capital you require. After you after evaluating the exact capital requirement, you need to understand that I have to make available from the sources which are very optimum, which are cost of which are very least. Cost of very the cost of capital should be very least. And the second thing is allocation of fund. You need to evaluate that how much investment you require in fixed asset, like a long term asset, like building, land, being furniture, and other machinery you require in your business. And you also need to evaluate the how much working capital you require. Working capital means the capital which we require to for continuing the operation of the business, such as inventory, to inventory for inventory, and paying the utility bill like telephone bill, other utility bill like laundry, and laundry being a electricity bill, etc. You have to make sure that uh, am- the ample amount of cash should be readily available every time to, so that you will not be able to you will not be able to pay the these expenses. And the third thing is the third thing is you you need to evaluate that what is the rate of return or you are getting on your investment. For suppose you have invested 10 lakh in restaurant business, and you have procured that 10 lakh from your relatives and your banks and etc, and you know that you have to pay at least 6%, at least 6% interest on that capital, that will cost you around 60,000. and and you know that after this in after this investment of rupees 10 lakh, I will able to generate profit of 3 lakh in 3 lakh in a year. So uh, and so you evaluate that you will be able to generate the revenue, a revenue of 6 lakh, and your operating expenses are around 4 lakh, and the so rupees 2 lakh profit will be available to repay your financial expenses. And still after paying the financial expenses, you have 1 lakh 40,000 which is left with you, so you can use in your business, or you can withdraw it for your own personal expenses. So so finally, we will discuss the some of the benefits of the financial management in hospitality industry. That what are the benefit we can derive from proper financial management in any business which relate to hospitality industry. The first one is profit maximization. The how the we will now understand the how financial management help in making good profit. Financial management tells us about the proper allocation of funds in most profitable activity. So when we invest when we invest our funds in most profitable activity, that will lead to generate a good amount of profit, and that will ultimately make the organization profitable. The second thing is wealth maximization. Wealth maximization Wealth maximization means the first and foremost objective of the financial management is the maximization of the maximization of the value of the business, or maximization of the wealth of the organization or wealth of the owners. So so when you continuously making profit by proper financial management, you will ultimately lead to creation of wealth, or you will wealth with your wealth max, will maximize in upcoming year. And and, and the third benefit is proper estimation of total financial requirement. Proper estimation of total financial requirement. Financial management help us to evaluate that how much finance or how much capital is required to run a business, because it tells us about the how the resources should be allocated, in which proportion it should be allocated. So it gives an idea about the how much total capital we will require at any point of time to run the business. Financial management also help us to plan a proper utilization of finance, because if you fail to utilize finances in a proper way, it will ultimately lead to decrease in a profit, and that will ultimately lead to close down of your business. And the next benefit of financial management is maintain a proper cash flow. So we will now understand the how the financial management help in maintaining a proper cash flow. Financial management involve allocation, proper allocation of funds into the business, and proper allocation of funds in profitable investment. So when we invest in a profitable investment and cash rich investment, it will it will make organization very cash rich, because because when we when we allocate when we do not allocate our cash in some non profitable activities, and less cash generating activity, that will that will that will increase efficiency of financial operation in organization. And financial management also tells about that how your credit policy should be there, that how much credit you should ask from your supplier, and how much credit you should allow to your debtors or receivable or customers. So if you have a strong financial management policy or credit policy for your customer, for your supplier, you will there will be a very less chance that you will fall short of cash. So this is how it will help in proper cash flow. And next one is survival of the business. So survival of the business. So when we make a sound financial management policy in an organization, as we have already discussed, sound credit policy, that how what should be the policy, uh, recovery policy for customer, for or credit policy for creditors. So if you have a strong financial management policy for a asset or for procurement of funds, you there will be a very less chance that you will suffer from cash shortage, or closure of any activity or any business activity, and that will help us to help in survival of business in any unfavorable situation also. Because because if you have enough cash, and if you have enough funds available with you, and you have enough reserve available with you in tough time also, as we can see in this COVID pandemic, some of the hotels and some of the restaurants have closed down due to non availability of fund, or non availability of other financial resources with them. And and some resort uh, which were very good with financial management, were still sustaining or still surviving in this unfavorable situation also. So, and how financial management create goodwill. So goodwill is nothing but it is the reputation, or it is a reputation of a brand, or a business have in market, in the eyes of customers, supplier, banks, etc. So how financial management help in creating goodwill? Financial management will help you to help you to make good profit. It will help you to make good wealth. It will make it will make your cash flow very proper. It will help you to create reserve. And when your business have such sort of attributes, that your profit is very good, you have very strong credit policy, then then of course the goodwill of the organization will be very good. And the next one is the reduce cost of capital. Financial management always help us to reduce cost of capital, because financial management uh, tells us about the optimum tells us about the having the optimum capital structure. Optimum capital structure means the there should be a right proportion of the owner's capital and the right proportion of the borrowed capital, so that the balance can be maintained and the cost can be minimized. And it will also give idea about the what are the funds and what are the funds available in the market, and what types of funds are suitable for the business. So it will help in reducing the cost of capital. And next one is reduce operating risk. So we will understand how the financial management help in reducing operating risk. So, so before moving further, we will understand what operating risk is. Operating risk means your operation will not perform as you imagined, or you in in a proper manner. For suppose it can be due to any pandemic like COVID, or it can be a off season, or it can be any sort of other external forces, or any government restriction. So when you have a strong management policy, and your quality of the financial management in organization is very good, then you will you can say that you will mitigate the operating risk that you will going to face, because still you are facing operating risk, and then operating risk then still facing operating risk, but you have ample amount of financial resources with you, that you can sustain your business, and you can avoid, or you can you can avoid or mitigate the operating risk which organization is facing, by opening or by introducing some other business activities, such as like online, as you can see, the online food delivery, online, or you can say, yeah, online delivery, etc. Online selling of product, online selling of your service. And it will, and for this you need to have a strong capital base. Without having a strong capital base, a strong financial management, you will not be able to fight with operating risk. And the last and but not the least, the optimum capital structure. The financial management will definitely help in maintaining a optimum capital structure. Optimum capital structure should be there, because if you have more money, if you have less money in organization, you have lesser amount of fund, you will not be able to sustain in this competitive market, and you will not be able to provide this the quality service to your customer. And if your organization is overcapitalized, that you have extra amount of cash left with you, and you have overcapitalized, then also it is not good for your organization, because it will end up in increased financial cost. And ultimately, if your all profit will be if your all profit will be used in paying the finance cost only, then you will you will be fall short of you will fall short of other cash resources. So
Yes, yes, you are audible.
hello. So
Yes, you are
is there
audible.
I'm audible? So is there any doubt regarding, because so my presentation is nearly on end. Hello.
Yes, is it done?
Yeah, is it done? Yeah, presentation is done. You can we can discuss some important issue if you have something to ask.
We've got a few questions from the student side,
Yeah.
and these are really worth asking,
Yeah.
and
Okay.
that's why they need to be discussed in a view to keep abreast
Yes. Yes. Yes.
with the things that should be adhered with, because finance is very easy to speak about, but at the same time, it's very hard to handle.
Yes. Yes. Yes.
One
Correct.
question is there that normally people in small business,
Yes.
normally
Yes.
people, what do they do is they are coping up or they want to take the advantage of informal credit.
Yes. Yes. Yes.
That informal credit system is there rather
Yeah.
than a
Yes. Yes.
formal credit system that they should be following.
Yes. Yes. Yes.
If you
Yes.
can give a bit light on it, like how informal credit system, what is informal credit system and how informal credit system can become a harmful thing for the people who want to uh, work with an improper system of finance.
Yeah. Sure. Sure. So, basically, informal sources of finances are like you make available from of certain people you who are nothing but they are just normal people. They provide finance on high rates, and then they charge interest rate which is much more than the rate the bank charges. And and the in small businesses, the people do not have idea about financial management, and they are unable to the finance cost with the revenue. Because if even if they are earning 20% profit, but they are still paying the 24% interest rate on informal borrowing. And even if their operation are successfully run or successfully going well, then will ultimately lead to incurring losses. And in informal sources, there is there is no system of there is no proper system of recovery, or there no proper system of extending or deferring the time period which is allowed for repayment. So it is my advice for small businesses, or for a small restaurant, being a small hotel, to avoid this informal source of finance, because it will be very disaster for you, even if your operating if your operation are going well. So you should always go for the formal source of finance, like from banks, for NBFC, non-banking financial corporation, or from some sort of financial institution. So it is advisable that you should completely avoid informal sources of finance. So
All right, thank you so much. One more question is being lined up is about the impact of personal finance management on the
yes, yes.
business finance that you want to uh, get lent or you want to have a loan from. If the formal credit system is giving you loan, they will
Uh-huh.
also be looking at your personal finance management or the
Yes, yes,
credit card credit score that you have. So
yes,
in
yes.
that sense also, if you can suggest us some of the measures that the business finance and the personal finance or personal money should not be mixed. And
Yes,
if
yes,
the
yes.
mixture is happening, it will lead to, ultimately, it will lead to a kind of a situation where you won't be able to make out where did you
Yes.
spend this much of money. One mind of yours will say you have spent it for your personal